Hi, welcome to another webinar from Zerodha. This is Hanan here, and I'm going to be introducing Neil Parikh to you. He is a part of Parikh Financial Advisory Services Private Limited, and he has been a part of the capital markets for over a decade with experience across wealth management, research, institutional desk, marketing, operations, broking, key client management, to just name a few. So, like anybody else, he started his career as an intern with Morgan Stanley in 2003. He has been a part of Parikh Financial Advisory Services Private Limited since July 2004 in various capacities. At PPFAS Mutual Fund, apart from handling key client relationships, he is also entrusted with the fulfillment of strategic responsibilities. Keeping with his father Parag Parikh's philosophy, Neil believes in value investing and is a strong advocate of applying behavioral finance fundamentals in investing. His academic excellence is reflected in his qualifications from prestigious universities. He holds a master's in business administration from IESE Business School from Spain and a BA in economics from the University of North Carolina at Chapel Hill. He is an avid reader and a passionate golfer. He also plays several other sports for recreation. Without wasting any more time, I'll ask him to take over. Yours, Neil.
Thank
Please go
you.
ahead.
Thank you. Thank you, everyone, to spend your afternoon with me. I hope I can add some value in this presentation. So I'll just start. You know, uh, the world is becoming a much smaller place today, due to globalization, due to the internet age and the information age. We all know about a lot of things, and we are very familiar with a lot of brands that are outside of India also. Today, with the liberalization and the markets opening up, a lot of these foreign brands and foreign shops have come to India, and now today we are consumers of and users of those brands. So today, if you look at yourselves or look at people around you, the watches we wear, the phones we use, the clothes we wear, or the cars you see on the road are mostly all foreign built, and they're not Indian brands. So the biggest thing is that if we are such big users of all these brands, then why are we not such big investors in these brands? If we like these brands so much, and if we have so much affinity towards these brands, then maybe we should invest in them too and make some money for ourselves. But as a whole in India, this class of international investing hasn't yet taken off fully. And there are a few reasons for that, which I'll touch upon in my presentation. I do feel it's extremely easy today to invest abroad, and I do believe that it's a great opportunity for us to go beyond our borders to invest. So hopefully, in the next few minutes, I can take you through a presentation and convince you that this is a quite a good asset class. So first, I just want to show you this map. Actually, uh, this map is the market capitalization of the world. So each country is broken up into or is depicted with its market capitalization. So if you see, the world looks extremely different if you go with this map. The United States obviously is the biggest market. It takes the giant majority of the share there. You look at United Kingdom if you can. I mean, United Kingdom, it's quite small in our regular map, but it's such a big thing because the market cap of the country is quite big. Look at Japan. Japan is big. Compared to that, look at India and China. Having such big countries, we are quite small in this map. If you see, South America and Africa are completely they don't seem to have a place in the world only. So my biggest point here is saying that if you just look at India in this map of market capitalization, we are probably about 4% of the world market cap. So 96% of the opportunities are lying outside of India. So why should we restrict ourselves only to our country? So I feel we should look beyond our borders, because most of the opportunities lie beyond our borders. So like I said, that as Indians, we have not really taken off, or we've not really invested abroad. And there are a few reasons for geographical low geographical diversification. And this is not only for India, but this is for people from all over the world. First of all, people don't think beyond the LOC or the line of control for us, or beyond our borders. we are very comfortable in our little space, and that's true for everyone. Like, I mean, you are going to be comfortable in where you've grown up. So this is called an home country bias. So we are always very pro Indian, and we are pro our country, and looking at beyond our country, we don't find too much merit, or we are not too confident about that, or we might not have the basic knowledge about the other countries. But so we face this home country bias, and obviously there'll be a natural affinity in invest in domestic companies. So imagine if you invest in so there are companies like Patanjali or Dabur, for example. These are the things that we are familiar to, or we can relate to these companies. So for example, when I'm talking about Dabur, imagine if you have to understand a company like Dabur, you have to understand what the brand Chyawanprash is. Now Chyawanprash is something that only Indians will understand. To explain to a Japanese or a Chinese what Chyawanprash is would be extremely difficult. And similarly, when we go abroad, there are companies outside of our borders where a lot of these cultural dynamics take place, and we will not understand those things. So we are very comfortable in the brands we know or the things we've grown up with. This bias leads to missing opportunity to invest in overseas countries. So, like I said, 96% of the opportunities lie outside our country. So, first and foremost, we have to break these biases in our head that we are very comfortable in our own environment. Lack of knowledge and awareness was true a little while back, but since the internet has come, since the early 2000, the dot-com boom, we are very familiar, and and the internet has opened up all these opportunities for us to know about other things. Also, we can buy these things online today on an Amazon or a Flipkart. So we were aware of these brands, and we have knowledge about these brands. So now we can actually start looking at investing in these brands. So why global exposure is necessary? So let me just explain to you a few points about why you'd believe that global exposure is necessary. Let's look at these companies. Yeah, these are just some of these companies. So I mean, today, like it or not, we all are global investors. Now, if you invest in a Tata Motors, you have to look at a Jaguar Land Rover. I mean, majority of the profits come from this. If you look at Hindalco, you have to look at Novelis. If you look at Tata Global Beverage, you have to look at Tetley. So all of these companies have some global diversification, and now today to look at these companies, we have to look at other countries and other countries of operation that these people are doing, or where they've made an acquisition, and where we need to study them. So today we all are international investors. So again, if you look at a sector like pharma or oil and gas or metals or commodities, these we have to look at what's happening in America, what's happening world over, or what's happening in Saudi Arabia when it comes to oil. Because global oil prices or global commodity prices will be very similar everywhere, and the dynamics of business will be very similar everywhere. So we have to today, like it or not, we are looking already, all the analysts are already looking outside the country. So it's not that big a deal to go and look for companies outside our country. So one of the thing is that we are already global investors, we are already doing these things. So might as well, instead of only looking at our companies, if we are already looking at other companies, we should look at other companies in outside the border. Again, this is very interesting observation or opportunity that lies here. So look at companies like Nestle and 3M. So they have parent companies which are abroad, which are listed abroad, but they have their own subsidies. So they'll have an Indian subsidy. Nestle has its Indian subsidy, so does 3M has its Indian subsidy. Today, a Nestle and a 3M globally are listed at one third of the valuations of
And Neil, can you hear me? Uh, I think your audio has.
Oh my God.
Go- yeah, yeah. We're just checking. One second. Something has happened at your end. Now it's back on. Yeah.
Can you
Sorry
hear me?
for the interruption. Yes, I can
Okay,
hear you.
where did I stop? I mean, so I can just
They'll tell you. One second. Yeah, you can get started. No problem. You can go on as is.
from this slide onwards.
Yes, yes.
Okay.
All right.
So I'll
Thanks.
just repeat what I
Yes,
was
yes.
saying
Small
about.
brief, and then you can get started. Yeah, that
Yes.
would be nice. Thanks. Thanks a lot. Yeah,
No problem. No problem.
yeah.
So today we are getting interesting opportunities in the global in the global companies where it's called a valuation arbitrage compared to Indian companies. So companies like 3M and Nestle, they are global companies, but they have subsidies in different countries. So 3M and Nestle are also listed in India as subsidies. Now, today, the Nestle and 3M of India are listed at three times the valuation of the global company. The global company has businesses from all over the country, and it's not only taking a country-specific risk on India. So one third of so Nestle and 3M are available at one third the valuation. So these are quite mouth-watering valuation for such companies, and where in India they're trading at such high valuations. The other thing is that a company like Nestle, if you remember 2 or 3 years back, it went through its Maggie fiasco. There was lead particles in the Maggie, which really hampered its stock price, and the stock price took a beating in India. But the global Nestle had didn't take it didn't affect the global Nestle at all. So sometimes it's better to be invested in the global in the global company than the subsidiary, because the risk is much less. Again, I'll take you through another example of Maruti Suzuki. As we all know, one out of two cars in India is sold by Maruti. Maruti is a great company. The only thing with Maruti right now, if you ask me, is that the valuation is too high. So how do I participate in Maruti by not buying a Maruti? I will go and buy the parent company Suzuki, where 75% of Suzuki's profit comes from a Maruti. So, and plus, we get the Japanese business also with it, the Japanese car business, the Japanese motorcycle business, as well as the Indian motorcycle business. So, at one again, Suzuki is trading at about 16 times earning, and Maruti is at plus 40 times earning. So, with Suzuki, I can participate in the Maruti story. So, these are the interesting opportunities that are there in the global market. Again, the other thing is that absentee sectors and companies, today, if you want to go where the growth is, or where the where companies are innovating, and the innovative companies like, say, a Google or Amazon or a Tesla or Genentech or Apple, there are no equivalent companies or sectors like that in India. So we have to go look beyond our borders to find such opportunities, and these are really great companies which are growing at 30-40 times, 30-40% every year, and such giant companies. And we're very familiar with this. We are very familiar with these companies. Like, we all use Google, we have Gmail, or we have an Android phone. Apple phones are there. Amazon we all shop with. Tesla, we all know what the cars are. So we are all familiar with these companies, and these are really high growth companies which are available really at a good valuation, and where the Indian peer is not available at all. So we have to go beyond the borders to participate in such companies. Again, on the left side, you will have Accenture, Cognizant, IBM. On the right side, there's TCS, Infosys, Wipro. I mean, to be honest, these companies do pretty much very overlapping things. The what they do is quite similar. So if you like a TCS, Infosys, Wipro, then we can also look at an Accenture, Cognizant, and IBM. So in fact, an IBM hires employs more people in India than any of these three companies. So isn't IBM more of an Indian company than, say the TCS, Infosys, or a Wipro? So again, so a TCS, Infosys, Wipro sometimes will be at a high valuation, but if you want such similar businesses, then you can also look at these companies which are great global peers. And again, they have an Indian operation, and they are also available probably sometimes cheaper than the Indian in the Indian companies. So these are the kind of opportunities are also available. Other benefits of going international is, this from a portfolio point of view, a country it going global will reduce your country risk and reduce portfolio volatility. So today, in a portfolio, we don't want everything to go up or down the same thing. You want things which have low correlations to each other. So it's very rare that if you have geographic diversity, that everything will go together and everything go down together. So if India is going up, US is probably not going up that much, or US is going up, India is a little it's not there. So what this does is it reduces the portfolio volatility and the country risk. For example, we are going into we're going into a election year. Markets will be volatile at that time. If something untowards comes in the elections, you would expect the Indian markets to come down. But having some global diversification abroad will help the portfolio remain steady and balance the portfolio out. So there's a great advantages of having some of your portfolio outside the country, so it has a low correlation to India. Again, there are some companies which have a very they're very Indian in nature. So a Make My Trip, if you like a Make My Trip kind of a business, but you can't buy it in India. Make My Trip is listed only in the US market. So if you like such companies and you like the Indian flavor to it, then also you have to go outside the country to buy such companies. Winners keep rotating. I think I mentioned this before that uh, each country will today's best performer will not be tomorrow's best performer also. This happens in mutual funds also, it happens in stocks also, that a best performing stock or a mutual fund of this year will probably not be that the next year. Same with countries. So if India is doing good this year, China will do good next year, US will do good after that. So the winners keep rotating. So having some diversification will smoothen your portfolio out in the long run. Again, the strategy to use while going global is that obviously once you go global, there's a wider choice of companies to invest in. I mean, uh, it's limitless. But what you have to do, or funds have to do, is that you have to be with companies that are familiar to us, what we understand, the brands we use, which have global in nature. Like I mentioned in my early example of Dabur, that you cannot go for something which is too niche of a country, which has a country specific risk, or where too much cultural, where you need to know too much about the culture and the likes and dislikes of the people there. So we need to go with globalized businesses and brands that we understand and we use and we're comfortable with. So that's kind of the strategy to be used here. One of the things while investing abroad is the one of the risks to take care of is the currency risk. The rupee has always, or on average, depreciated compared to the dollar. If you see this chart, since 1989 till today, so from 1689, which was in December 1989, so today it's close to 70 rupees. So the rupee has always depreciated, but the rupee has not depreciated in all years. Some of the years the rupee has also appreciated. So one of the things to do while taking care of currency risk is you can hedge the currency. When you hedge the currency today, when you're hedging the currency, you're getting a 4 or a 5% currency premium. Okay, when you hedge, the reason we are getting a currency premium is that the US interest rates are much below Indian interest rate. As long as the interest rate differential remains, we will always get a premium on our currency hedge. So if you don't want to keep your currency unhedged and you're worried about taking currency risk, and which is fair enough, then you should hedge your currency, because you're still making a 5% currency hedge on it. You add, say, a 2% dividend yield to the international stocks, so you're getting 7% return on the stock without the stock moving 1 cent. So basically, you're getting debt kind of, or fixed income kind of returns without the stock going up 1 cent also. So any appreciation is above and beyond the 7% that I'm talking about. Another way of looking at it is relative performance between Nifty and S&P 500. The general belief is that Indian equities deliver far better returns compared to global markets. Well, this is not true quite a lot of times, because what we are doing is we're comparing apples to oranges. We are looking at S&P 500 in from a US dollar perspective, so we're seeing it in dollar returns. Whereas Nifty 500, or whichever benchmark you choose, is in Indian rupees. So we have to first make it all dollar to dollar or rupee to rupee to make it an apples to apples kind of a uh, uh, comparison. So what I have done in this chart is I've taken the 1 year, 3 year, 5 year, and 10 year return chart of the S&P 500 in US dollar and converted into in Indian rupees, depending on what the rate of the dollar would have been at that point, Indian dollar rate would have been, and look at the difference. So the S&P 500 has pretty much beaten the Indian markets in all years, in 1 year, 3 year, 5 years, and 10 year period. So the myth is wrong that, oh, India is the fastest growing, is one of the fastest growing, and we always deliver better returns. It's not true actually. Sometimes going abroad can make a difference, and we can get better returns than what we are doing it in India. So this is a very important thing to note, to take down, is that if you don't want to take currency risk, then hedge the currency. You're still making 5 or 6% on the currency. So as a fund house, this helps us a lot in going in managing money, and provides the cushion and the balance when we go forward. So there are two ways to invest in overseas market. You can actually go directly in stocks also. You can actually open an account in one of the platforms which are available today. With a good internet connection, you can trade on that. But obviously, it requires a lot of paperwork. Taxation will be very different. So you'll have to sit with your CA and figure out what the taxation would be, what are the paperwork required. So it's a bit of a tedious process if this is not your full-time job, or it's something that you are not very comfortable doing, because you will also have to be taking then decisions on buying and selling of stocks. And if you don't have a good enough research background, then it's better to go through someone who does have that. And going through a mutual fund makes probably a lot of sense, because what you're doing is you're not losing out on local taxation. Today, if a fund invests in international stocks, you're still being taxed as a Indian equity mutual fund, and this doesn't count towards LRS, or liberalized remittance scheme. Liberalized remittance scheme is that every Indian is allowed to invest 250,000 US dollars per year, and it can be on in any of the assets. You can buy real estate, equity, or debt. But beyond $250,000, you can't send more money outside India. But if you invest through a mutual fund, this is without losing the LRS benefits also. So this will be counted as your Indian equity fund, and we get the benefit of the Indian taxation here. So it is possible to think local and act global. So in summary, I would just like to just spend a couple of minutes on what we exactly do. So we are a multi-cap fund, and we are benchmarked to the Nifty 500. We follow the Warren Buffett or the value investing approach. We want quality company at reasonable price. The main USP of the fund is that we can invest 35% of our of the assets beyond the country, beyond India. So currently 30% is invested outside of India. And again, you get the capital gain tax benefits enjoyed by other Indian equity mutual funds. So it's exactly like investing in any other Indian equity mutual fund. And again, we don't take currency risk. We hedge the currency completely. We are not experts in currency. And with this currency, like I mentioned earlier, we are actually making a 5% yield on it. So it really helps us in delivering the higher returns, and giving steady returns, more like it. And again, we only have a growth option. We don't believe in the dividend option, because equities is meant for long-term wealth creation. So I think only a growth plan is necessary in an equity fund. So thank you, everyone. That's a little presentation from my side. I would love to take some questions if you all have any. Hello, hello,
Hi.
hi.
Yeah. So, Neil, I
Yes.
think there was, I mean, terribly sorry about it, but I
Hmm.
think from somewhere with the connectivity, there
Okay.
have been a couple of issues. So I
Okay.
mean, although we still have a huge audience watching this
Okay.
compared to what we generally have,
Hmm.
because I think you were a big draw. And
Thank you.
still, I'm guessing if we need more information from you eventually, I hope you would be able to share with our
Of course.
audience.
Of course. That's not
Great.
a issue at all. Yeah.
Great, great. So I'd like
Yeah.
to ask you a few questions
Sure.
so that
Hmm.
people can understand what
Hmm.
it is that. So one of the simple questions which one of our users asked was, why aren't many global subsidiaries listed in India?
Why aren't
They're all here. Like you have those
yeah,
brands here. You have all the big cars selling here. All of those things happening.
yes,
But why aren't
yeah.
they listed here?
So they're not listed. So today, I honestly don't think the where the country of listing really matters. So obviously, people would like to list on the US exchanges because liquidity is far greater there. And here in India, it is still a developing market. So liquidity is not that much. I think going forward, you'll probably have more people listing here. But I think the preferred, like I showed you from the map, if you saw the
Hmm.
first map, that
Hmm.
if you're listing, if it's the global, if you're a global player and you're listing somewhere, you would want where the market caps are the biggest. So a lot of the companies are listed in Western Europe and US, and I think it will continue being that for some time. But slowly and steadily, I think as the as we start growing, you will see
Hmm.
more listings coming in our in the country here. But right now, I don't think too many global players would want to list here
So
due
you're
to the
saying
liquidity issues.
I understood. Yes. So
Hmm.
you're saying if anybody has to be a smart investor, he
Hmm.
needs to look west and see where, because those are the developed markets. There's a lot of money there, even though the markets are highly developed. You see there's still potential for more upside for people over there when they invest in those markets.
Absolutely. So I'm not saying on a taking the whole markets as a whole, but within those
Specific stocks.
markets.
Okay.
Hello, can you hear me?
Yes. Yes.
Yeah. So within the market, there are actually some great opportunities. Even currently, even the US markets at an all-time high right now. But there are certain companies which are compared to the Indian peers are trading at a very much of a discount and are growing at 30-40%, still. And these are global companies that we all understand and we all know about them. So I think there are some great opportunities lying outside our borders, and they are actually available at a reasonable valuation. So I do think there are great values available outside India.
Great. So, as investors and traders, people have a lot of investors. I mean, we have a lot of investors at
Mhm.
Zerodha,
Yeah,
and most of them ask us questions like, "How can I invest in a stock which is outside?" Like they want to invest in Apple
sure.
or they want to invest in
Right,
some other company which is doing
right,
well.
right.
So, I think the suggestion should be is just invest with PPFAS, and they'll take care of the rest of the things. Is that right,
I
or
hope so.
is that pushing it too far?
So if you want the taxation benefits of because when you invest, you can actually invest. It's actually very simple investing by yourself also outside the India. I mean you
That's
can
what people want to know. Yeah, yeah.
yeah, so you can open a brokerage account. It's any of these things, and there's some paperwork involved, which I mean, it's there wherever you open accounts, there will be some paperwork. There's some paperwork involved. Obviously, taxation and all, you'll have to talk with your CA and figure out how to best to go about those things and how to best account for those things. But it's actually a very simple thing. But I would not recommend everyone to do it, because if you're not a research analyst, or you're not very interested in this field, and you need to be aware of what's happening in those companies also. So if you don't have the time or the resources to do it by yourself, then a mutual fund would be a great a great way to invest abroad. But if you're
Great.
if you're fine with doing it yourself, then that's also an option. It's not very hard.
All right, great, great.
Hmm.
So now, considering these international investments
Hmm.
and considering the rupee, or considering the currency fluctuations, you did
Yes.
mention this earlier in your talk also.
Yeah.
So how should one view this? Like, if the rupee is going down and if he's
Hmm.
invested in an
Hmm.
international stock,
Hmm.
so how does an
Yeah.
investor, like even in the mutual fund? Let's focus only on the mutual fund. Yeah.
Okay. So from a mutual fund thing, from our perspective as a mutual fund, is that we don't claim to be any experts in currency, and that's one risk we don't want to take. We don't want to take currency risk. I mean, yes, on average, the Indian currency has always depreciated, but there are years where it's appreciated also. If the rupee appreciates, and if you keep your currency risk unhedged, then you lose
Mhm.
money. As long as the rupee is depreciating, you're making money as an Indian. But what
Okay.
I'm saying is that I don't want to take that currency risk, because I don't know. I have no clue what happens to currency. I have no clue what rupee dollar will be 1 month, 3 month, 1 year, 5 years down the line. I'm not comfortable taking that risk. So what I'm saying is that I like to hedge the currency, because today when I hedge the currency also, I'm making a 5% premium on that hedge. So any capital gain, say if say one of the companies make 12%, so 12% plus 5%, so I'm making 17% in that stock. So my 5% is actually free, kind of, it gives cushion to the mutual fund, So I think that's a great benefit actually to hedging the currencies, that you're short making 5% right there.
Great, great. I think this is going to be really useful for people.
Yeah.
And do you as a fund house, worry about these geopolitical risks, given the times we are in? Like, there's a lot of right wing politics going on, and
Mm.
people are trying to, like the make in India philosophy, they're all like, let me keep our money within this system.
Yeah.
So with those kind of risks, do you think those are risks, or do you think it's just talk?
So it's part and parcel of our life, I think, today. I mean, whatever we talk about, there's always something. Today, there will be one thing. 2 months later, there'll be something else. So all these macro events will keep happening. We are also coming to an election year, so that will keep us on our toes. It'll keep the markets volatile for the time being. Trade wars are always a fear. What will Trump do? These things are always, they're going to be there. I mean, you can't do anything about it. It's not in our control, the macro problems. What we as investors or advisors can do is that we can look at companies on its own merit and see how this company is going to do. So regardless of what happens in the macro world, will these companies still do well, and will they be growing, and in 10 years time will they be better than what they are today? I think we look at those, and those are the things that are in our control, the analysis part of it. I think we should just look at those things. Macros will keep happening. I mean, there's no end to macros. So
Mhm,
uh,
mhm.
yeah, it's something that you need to honestly cut off the noise in that way. I mean, but you can't. I know it, but to the best of your ability.
All right.
Hmm.
So, and you covered this also earlier. So,
Hmm.
there's an access to index funds for a lot of people, to international index funds.
Yeah.
So, why shouldn't they just go ahead with that and instead invest in a mutual fund? I mean, I know the answer, but I'd like you to give the answer to people.
So again, the choices of the investor, there are index funds, and if you want to just mimic the index, these are fine, you can. But if you want to actively manage portfolio, first of all, in actively managed stocks, then someone who's actively managing and who can take the call that, okay, from these 30 stocks, only these 3 stocks are really good, and I'll invest for these for the long term instead of taking the full 30 basket. So if you want an expert kind of investment advice on that, then obviously an actively managed mutual fund is much better. Secondly, is the tax benefits that you get through the mutual fund route. So if you invest through our fund, then you will be treated as an Indian equity mutual fund. So exactly how any other, your taxation will be exactly how your other mutual fund would be. In an index fund, I'm not really sure, but I think the taxation is also different, and you'll be uh, and, and I'm not exactly too sure how the taxation works, but I know it's much different than doing this. So I think the mutual fund is just an easier route to go through.
Great. And will PPFAS invest only in the US, or like you have mentioned Western Europe, so highly developed economies you are going to invest, or it's focused only on the US?
That's a great question, actually. That's a really nice question. What we are looking at when we go abroad, or when we look beyond our borders, is to first of all find globalized businesses. I mean, like I said, I mean, you don't want to get into such niche businesses where again you're taking country risks. We're already taking country risk on India. So tomorrow, whatever, if India Pakistan have a war, India will go down. So we don't want to take a country specific risk. We want globalized businesses where the business is spread across the world. That's number one. Number two is we want to go to countries where corporate governance is not an issue. Today, a lot of people tell me, why don't you go to China, Russia, Indonesia? Some great opportunities are there. I'm like, I'm not too comfortable with the corporate governance there, and how minority shareholders are being taken, how they've been treated. So that those are two things. And the third important thing actually is, it might sound quite naive, but it's quite important, is that the balance sheets need to be written in English. I don't want a balance sheet which is written in a foreign language and then translated, because as we know, we always get lost in translation and the nuances. So these are the three factors we look at, and because of these three factors, we keep ourselves only with say US company, and a lot of the companies are listed in the US. So we deal with the US market as ADRs or something like that. Western Europe is good, and we bought Suzuki, which is a Japanese company, but Suzuki was not. It was fine because we are very aware of what's happening in Maruti, and we are aware of that company. So these are the kind of developed. Yeah, you're right. We'll stick to developed countries for the
Great,
time.
great. So that's a safe bet for everyone, and there's a
Yes.
fair chance of
Yeah, and,
making
and,
good
and, and and
returns.
information is available, information is
Right.
available. You can talk to people. There's transparency when you look at these companies and in these countries. So that's a big advantage also.
All right. So, given the recent news on Facebook,
Hmm.
how do you think it's going to play out, considering there are investments and all connected
Yeah.
with it?
Yeah. So actually, we're very we like Facebook, and we're very confident about Facebook. This was obviously in our mind, it was something which was quite expected, because when the privacy issues happened, and the Senate hearing happened, and now that they're saying that they're going to spend a lot more on protecting privacy of people, and taking out the fake news, we knew there was going to be some capital allocation towards that, and also there will be some loss of business. So near term, yes, like they had obviously in the conference call also, Facebook has said that for the next 1 or 2 quarters could be bad, and will bad in the sense that they will be missing it by a point 1 or 1% of
Mhm.
their targets. So it's not that. For us, it's like, if you want to hold the company for 5 or 10 years, these are things that will continue happening. They will miss quarterly targets. The reaction, I think, was a little bit overdone, but well, I mean, they're also risen uh, quite fast, quite soon. So it's fine. We're confident with the valuations that are there, and we're confident that the profitability will continue staying there in Facebook. So we continue to hold the stock.
Great.
Hmm.
And well, one last question
Yes.
before we say thank you. So, what's the philosophy behind PPFAS investing? Having just one fund out there.
Sure. That's again a really good question. One of the things that we set out to do when we started a mutual fund is that biggest thing is like we don't want to confuse the investor. Before we were a mutual fund, we were running a PMS, and we also have a wealth management division where we used to advise on other mutual funds. Now, as professionals, when our clients came to us that saying that okay, advise me 3 or 4 other funds, and whatever it is, we were actually quite shocked that we had to go through all these schemes, and we didn't see too much differentiation, and there were hundreds and hundreds of schemes, and we were thinking that as professionals it's so hard for us to make an informed decision on which scheme to invest in. It would be hard for a lay person to do that, and again, what we said, that once we start a mutual fund, we'll keep it extremely easy and simple and not confuse the investor. We'll have one scheme where we can take advantage of everything within that one scheme. So today we can, in our this one scheme, we can invest across sectors, across geographies, across market caps. So I don't really need to uh, launch more and more schemes just to garner AUM. I feel within this one scheme I can take advantage of everything. So let not confuse the investor. I think that is the biggest thing, is not confuse the investor.
Great, and I
Yeah.
hope that the fund continues to do very well,
Thank you
and
so much.
with you at the helm, I'm sure it will. And
Thank you so
it was
much.
really nice talking to you, Neil. And
Thank you.
we will probably have Ask Me Anything session on Trading Q&A, which is one of our forum kind of a blog. So some of these our users ask very interesting questions, and you might have to write your answers down on that forum.
Oh, yeah, yeah. That's not an issue. I'll be
Great, great.
more than happy to do that.
Great. So we'll have that set up. Thanks again
Definitely.
for your time,
Thank you
and it
so
was a pleasure
much.
listening to
Thank you
you.
for this opportunity. Thank you a lot
Yeah,
for this
yeah.
opportunity.
Bye
Thank you.
bye. Have a
Bye
nice day.
bye.
Yeah,
See you.